Hi guys, this is me Finance by Swag, and in today's video we are going to talk about management of your investments for the young investors. How to manage your investments, how to manage your portfolio, we will learn today. So many young people in India today trade and invest in stock market. Yesterday only I was in a junior college delivering a financial literacy lecture when I asked students that how many of you invest in stock market. Most of them told me that they only trade in stock market, which is totally risky. So I thought of a video where I will explain you the art of managing the portfolio or art of managing the investments. The most common reason why young people fail in investing is they lack the basic understanding of stocks, diversification of funds, and they misunderstand the power of compounding. But it's not hard to learn. Moreover, the earlier you start, the more time you have to build your wealth. Managing your investments is investing into variety of assets like stocks, bonds, real estate, and maximize your return on investments while reducing your risk. But first, you have to decide your risk tolerance, that is the amount of risk or the total risk you can bear, and to set your financial goals. With regular monitoring of your investments and rebalancing or reshuffling of investments when needed, you can attain financial independence early in life. But first, let's understand how to invest and build a portfolio. While investing, you may be tempted to select stocks which are familiar to you, or maybe some hot stocks which are new in media. But this is not the best way to select stocks and to start your investing journey. Instead of that, invest in wide range of stocks of different industries and do diversify in different asset classes also. Building a good investment portfolio, do follow these steps. First one, determine your financial goal. Financial goals can be long term like planning for your investments. They can be mid term like planning for your child's education or maybe buying a new house. It can be short term also like planning for your next Diwali trip. Plan your goals properly so that you can allocate your funds accordingly. Second, evaluate your risk bearing capacity. You can be aggressive or conservative with your money. I have seen friends who get frustrated and depressed by just losing 500 rupees in stock market, and I have seen other people also who sit relaxed even after losing lakhs of rupees. Your risk bearing capacity is how much of money you can lose and still be stable. In a common layman's language, let me tell you that if you lose X amount of money today, you would sleep good at night. You won't have a sleepless night. That is your risk bearing capacity. As simple as that. As your mental well-being is dependent on that, risk evaluation is one of the most important steps while investing. Third one, select the mix of asset classes where you want to invest. Your investment should totally depend on your risk tolerance and your financial goals. Once investment is done, you need to check your investments regularly and periodically. Now this period may depend from person to person, as long-term investments who invest in risk-free assets may check their investments like quarterly or 6 monthly also. But investors who invest in risky assets may check their investments daily, weekly or monthly also. It totally depends on how risky is your investment. A aggressive portfolio generally includes 60 to 70% of equity allocation, and a balanced allocation can be done in cash and fixed income securities. A conservative allocation on other hand is exactly opposite to it. 60-70% is invested in fixed income securities and balanced 10-15% is invested in cash and the rest is invested in equity. Now let's deep dive into diversification of funds, which is the most important step one can ever have and learn in investing. You all have heard the old saying that don't put all your eggs in one basket. We have understood that managing your investment smartly means diversification of your funds into different classes of assets and securities. The goal over here is very simple: to hold a range of securities or assets which are not highly correlated, so that one type of asset or securities may not affect the total investments. When two asset classes are highly correlated, they tend to move in the same direction at the same time. I'll give you a simple example. In COVID times, pharmaceutical companies were on a great boom. They gave us high return on investments and all pharmaceutical companies were moving in the same direction, up, up and up. But nowadays, let's check them. They are not giving as good returns as they were giving in 2020 and 21. On the other hand, holding securities and assets which are not highly correlated will help us with pricing moving in different directions, So, one positive performing asset or security will balance out our one poorly performing asset. This type of diversification is industry specific, where you hold different assets of different industries. Let's discuss another way of diversification where investing can be done in small, medium and large companies. Large companies, even if they pay us lower return on investments, they are rarely affected by external events. Small companies are very much volatile. Even if they give us higher returns, they are very much affected by external events. One such event we have all seen is Russia and Ukraine war, where small and mid-cap companies went for a tumble, where investors have lost a lot of money. A easy way to achieve good diversification for young investors is to invest in index mutual funds or ETFs, that are the exchange traded funds, where they can replicate the broad asset classes in Nifty 50, Nifty 100 and similar indexes. Now, if you are investing in mutual funds, make sure all your mutual funds are not investing in similar companies. They should be diversified also. Diversify your mutual funds into debt category, some in equity and some in hybrid category also. Now, let's understand how seasoned investment professionals invest. First, they will ask you your financial goals and then your risk tolerance. Now, carefully answer this question because this will depend your success of investments. For example, if you are planning for a Europe trip in next Diwali, which is around 3-4 months down the line, you cannot tell them to invest in risky securities because you never know what type of market will be there in next 3-4 months. But tell them that I want my money in next 3-4 months, which is very much short term. Just park my funds somewhere so that I will get higher returns than my savings account. Your risk over here is very limited and he has to manage your funds accordingly. Second one, never forget to research your potential investments even if they are told by your financial advisor. Third, stay diversified. Even if you feel to invest all your money in one asset class, always diversify your funds in gold, some in stocks, some in fixed income securities. Keep emergency fund also. In fact, I would tell you exactly the opposite thing. First, plan your emergency fund for the next 6 to 8 months of expenses and then start your investments in whatsoever manner you want. Fourth one, always monitor your investments, reshuffle it, rebalance it as market conditions are needed. Fifth one, always consider long-term goals. Your financial advisor will tell you to look at the long spectrum. See, look at the long view. You should plan for your short-term goals, but more of it is long-term planning when it comes to proper investments. See, you have to keep it in mind that no investments or portfolios are foolproof. Best constructed portfolios are also impacted by external unexpected events, recession and market disruptions. But by following all these best practices, being disciplined and having a long-term goal, you maximize your opportunity to become financially independent early in life. Do click on the subscribe button so that you don't miss a single video where we are making finance fun. Till then, next time, keep investing and keep growing.